As we approach the end of 2024, many real estate investors are asking, how can I plan strategically and proactively for 2025 to optimize my portfolio and build real wealth? On today's episode, we're diving deep with certified financial planner Kyle Mast to explore when and if you need a CFP, key strategies for tax efficiency, portfolio diversification, and portfolio optimization for real estate investors, so you can make the most of the year ahead. Welcome to the RealWealth Show. I'm your host, Kathy Fettke.
You're listening to the RealWealth Show with Kathy Fettke, the real estate investor's resource.
Before we jump into the show with Kyle today on 2025 financial planning for real estate investors, I wanted to mention that RealWealth has a live event coming up in January. RealWealth's Passive Wealth Expo, How to Thrive in 25. You can join us in San Francisco on January 18th. At this event, you'll get to hear my live 2025 market predictions, talk to property teams in person to find your next investment property, and connect with fellow investors, and so much more. Just visit realwealthshow.com and click on the Connect tab. You'll see the drop down for live events. I look forward to seeing you there. So let's bring on Kyle.
It's so good to see you again, Kathy. We saw each other at the BPCon a little while ago, and yeah, it's great to be back. This will be a fun conversation.
Yeah, your last episode was really popular, so I know we're in for a treat. But before we jump into 2025 financial planning for real estate investors specifically, can you just start telling us about your journey to financial freedom?
Yeah, I'll just, quick overview. Some people maybe have heard me on another podcast, so I won't make it long. Basically, I grew up on a Christmas tree farm, a farm boy working, went to college, started working at a financial firm out of college, ended up buying some clients from that firm. And the whole time, back and forth flying to college, I'm in the airport buying financial independence, financial planning, personal finance books. You name it, Rich Dad, Poor Dad, David Bach's books, The Millionaire Next Door, kind of a lot of people's journey, just soaking that stuff up. Did finance in college, but most of what I learned was, from books outside of college. Got my CFP, my certified financial planner in there, bought a small book of clients from the current firm I was working at so I could start my own firm, and built that over a few years. During that time, bought some real estate as I looked at clients' balance sheets and saw continually that real estate investors were the ones that had the most wealth, those along with business owners, people that developed a business and either sold it or transitioned it well. So those are the things that I did. I bought real estate and then I sold my financial planning firm a couple of years ago. So now I'm just a full-time real estate investor, dad of 3-year-old twin boys and a 7-year-old boy, and just, living the dream, I guess. I don't know if it's like this early retirement thing because I don't feel retired, but yeah, it's a good way to go.
Well, the funny thing about early retirement is you find yourself doing things that you would have done were you not working, like before you ever made any money, which is apparently probably changing a lot of diapers right now.
Yes. Well, we're past the diapers. Thank goodness.
Thank
goodness.
Yeah, well,
yes, we are. They are potty trained 3-year-olds and we love it.
Oh, wonderful. Okay, so there's so many things I want to ask. Like, okay, first of all, it has nothing to do with real estate, but what was it like to grow up on a Christmas tree farm? I mean, that's just, I've never met anyone like that.
Yeah. Oh, that's so funny. There was I remember someone saying, oh, you guys must just be so happy. You just you're on your Christmas tree farmers, just happy all the time. And
so fun.
it's good. It's hard work like any farm. The cool thing is the summers are kind of slow. So we would do family road trips. That was very cool. It was in the Pacific Northwest. So growing up on a Christmas tree farm, you harvest trees in like 39-degree rainy weather. So it's pretty cold and miserable during that time world. Man, if any college student wants to have the experience of their life, go work on a Christmas tree lot. And it's like, go, sell as much as you can, as fast as you can. Just a lot of fun.
It sounds like you grew up in a business family, an entrepreneurial family, and then created your own business and sold it. So congratulations, really, really great. So how were you able to buy your first properties? Was it pretty traditional? Down and.
Well, not real traditional. We had bought a townhome, my wife and I, and there was 3 units, next to each other, and the middle one was being rented out. And we heard that the owners were selling the middle one. We were on the end. The middle one, we got to know the renters already. It was a young family. They'd been there for a while. And I wanted to buy our first real estate property. And this was at the point where I had just started the firm, I think, and I was making like nothing. I always say that on these podcasts that my wife is my venture capitalist, because she was the one making the real money at an accounting job, keeping us afloat and paying our debt down. But this property came up. We didn't qualify enough to buy it. We had enough for a down payment, but our income wasn't enough the bank wouldn't lend to us. So I actually had my dad co-sign on it. He didn't do anything else. He just co-signed on the loan, and we were able to buy it, put the down payment on it. It cash flowed well. And I think I refinanced him in about a year or so. We were able the income went up a little bit for us. And I wanted to get him, the family finance stuff. I've seen it enough. Yeah. I love doing it, but I also love honoring it and moving past it when you can. So that was our first property, and it just started going from there. We would save up more down payments as fast as we could. We lived really simply, buy a duplex. We bought some out of state, made some mistakes. And then we bought some with you, Kathy, which went a lot better than me trying to do it on my own out of state. And then we've gotten into the short-term rental thing too, after I sold my firm. But yeah, that's kind of the real estate story and how we got started.
So cool. So I had the same experience when I first became a mortgage broker in 2004. And I would look at all these really wealthy people's financials because they would just put all their financials in front of me. I had to know everything about them, right? And same thing. It was they either owned a business or they owned real estate. And it was so inspiring. So I'm sure as a financial planner, it was the same thing. And I'm curious because a lot of people give me a hard time about how heavily invested I am in real estate versus anything else. And every time I sit down and try to make sense of other ways, it just I can't figure it out because I can't leverage. I don't get the tax benefits. There's this, like if I would need money, I can just refinance a property and take the cash out and not get taxed. So just from your really unique perspective, knowing the options, all the options that are out there, what are your thoughts about, being too heavily invested in real estate or having a more balanced portfolio? Like, what do you see as perfect?
Oh man. Well, there's no perfect. That's for sure. Yeah. I'm listening to you talk, and it's spoken like a true real estate investor.
I know,
a real estate investor, it just runs through your veins. It's just like, why would I do something else? And I did, it's a unique perspective because a lot of financial planners, a lot of financial advisors don't specialize in real estate. And I naturally started to with clients because I started doing it more and more. And the early financial independence movement, both of those things were kind of what I gravitated to more. And, it's kind of just a preference as far as if you want to educate yourself and know real estate well, it's an amazing way to go. However, it does take some education. It really does, more than a lot of things regarding, you're talking about leveraging and tax benefits. And that's so true. And you can hire people to tell you that stuff, but you have a responsibility to know it yourself too. Otherwise, you don't know if you're talking to someone who knows what they're talking about. They're just telling you something. So real estate leans more towards, you have a little bit more responsibility. Whereas if you want to just sock away in your 401k, Roth IRA, a brokerage account, you can read, The Simple Path to Wealth, one of these books that it just talks about index fund investing. You can read one book, you can just sock a whole bunch of stuff away and you're going to be fine. It's a fairly passive way to invest. In 15, 20 years, if you live well below your means, you're going to have a sizable portfolio, but you're going to have to watch out for things like taxes down the road. Yes. I would just say, when I look at it, if someone is too heavily invested in real estate, when I was a financial planner, I'd look at it and you're always talking about percentages. Should I have 50% real estate? Should I have 50% in the market, in the stock market? And it's just such a personal preference thing. And it really depended on the person's situation. One of the things that real estate investors do get into trouble with is, you said, I can just refinance a property to get the money back out. Yes. But how long does that take? And how fast do you need the money? Mm-hmm. And what is the lending environment currently like, and what's the value of your property. So some of these things, the liquidity piece from a real estate investor standpoint is really important. And that's actually why I like having a little bit of both of those, because even a retirement account, a traditional retirement account, even if you're earlier than traditional retirement age and you might get penalized for taking some out of it, if you need it really bad, you can get to it.
Yes.
And you can get to it pretty fast, even if the market's down. If you had an account that had 100,000 in it and it went down to 70,000, you still got 70,000 and you can get it tomorrow. You can sell it today and you can wire it to your bank tomorrow if there's an emergency. That's the difference between something like that and real estate. And it's a pretty big difference. I'm a big fan of having a decent amount of reserves so that you can do a lot of your investing in real estate because of the things you mentioned. The economy we live in, the government we reside under benefits real estate investors because it benefits the economy. And inflation is just a matter of fact that our government tries to keep in place at a certain level. And real estate is one of the best inflation hedges out there, not only because it naturally inflates itself, but because you can leverage it and get more return beyond inflation. If you're buying good properties that cash flow and cover themselves, we're assuming a lot of, good education and knowledge there. But yeah, the real estate, again, like you said, looking as a mortgage broker, you're looking at all these financial statements and the businesses and real estate really advance the wealth. Just a lot has to do with the governmental and economic system we live under that really prioritizes that.
Yeah, exactly. Okay. Well, yeah, because my nephew is a financial planner and he's, always sitting down with us and Auntie, you need more liquidity, and I'm like, well, maybe, but it's the taxes. Like you could make all this money and then you got to give it away to the government. And that is one of the secrets of real estate. It's the secret's out, obviously, but.
For sure. And you're just doing what the government's telling you to do. Like everyone, a lot of times people say, you're just trying to avoid taxes. I'm trying to do what the government wrote down in the code for me to do. They said you have to depreciate your proproperty. You have to. Some of these things, yeah. So it's not, I just always like to say that. I think it's Tom Wheelwright, the tax guy that talks about that. The government their tax code is just a list of incentives for what the government wants you to do to drive the economy in a certain direction for some reason. And when you're following that as a real estate investor, you're doing the government a favor. It's kind of, I think,
and you're providing, you're providing a service called housing, which is very much needed. And the government tried to provide housing, still does in some cases, but it really didn't work out so well. It changed to, okay, let's have people provide the rental housing and we'll give them incentive. So, okay. So when should a real estate investor talk to a CFP, certified financial planner, and what should be the questions they ask?
I think the first one would be to ask them if you could ask them if they own real estate themselves. That would be a good question to ask. They don't have to own real estate themselves, but if you're a real estate investor and you're talking to a financial planner and they don't own real estate or haven't specialized in working with real estate investors, I think you should find someone else. And that's nothing against that financial planner. There's financial planners. The cool thing now in the last 10 years is this big push in the financial planning industry to really niche down. So there's financial planners that are huge on stock options. There are ones that are specialized in real estate. There are ones that specialize in industries like dentists, doctors, very specific things, union workers. So if you can find one that specializes in real estate, which means they likely own real estate themselves, they're going to catch things. They're going to be like, okay, you didn't bonus depreciate last year when you had a whole bunch of income and you have this short-term rental. Why didn't you do that?
Yeah.
I have no idea. My CPA didn't tell me. Well, but not all tax preparers are created equal either. If the more specialized you can get, especially as you get more and more into real estate investing, if you have one rental, I think just about anyone could do as far as a financial planner or financial advisor. And I should say, I'd like to make a distinction there. A certified financial planner, a CFP, is someone who's passed some more elevated certifications and has a higher ethical standard than that they're held to by the CFP board than just someone that might call themselves a financial advisor and not have passed that yet, I would say that's a good place to start, because you're already moving to the top of the list as far as financial advisors go. So a certified financial planner. But yeah, one that specializes in real estate. I mean, the cool thing is, in the industry, it's usually a bunch of us nerds that get into it. And then we start using the stuff we learned to benefit ourselves. Like everything I learned about working with real estate clients, I've learned it because it benefits me from tax standpoints, from, long-term legacy planning, estate planning for my own family. And if you find someone like that, they'll be able to help you because they want to learn more about it themselves. It's just this natural progression together. So I would say, I think you were asking, like, when should someone talk with someone? If you get past that first property and you plan to do more, I definitely think you would want to find someone that specializes in real estate, because you're going to gain so much from whatever you end up paying them, whether it's an hourly wage or an hourly rate, or like an annual retainer fee. A lot of them will do, you're going to, if you say you pay someone $5,000 a year as a retainer fee, a financial planner, which is a fairly standard one out there, it'll be higher and lower depending on one that you talk to. If it's a fee only retainer type situation, they're going to spot things in your first meeting that's going to save you 30 grand. I mean, it's that easy for them initially, and to point you in the right direction. So, I'm not in the industry anymore, so I'm not trying to take on clients or anything. So I'm not.
No, that's what I love about your advice.
People to you. Yeah. Good.
You're not selling anything. It's really great. Okay. So what you're saying is, then, for someone like me, I would meet with a certified financial planner and just show them the whole portfolio, and just, they would be able to look at it also from a real estate eye if they have that experience, and show us where we're maybe making mistakes, because we've really relied more on our CPAs for that. But I'm so embarrassed to say that we just sort of looked at our tax return from last year and realized the CPA had been using didn't calculate the expenses for the short-term rental. We paid a huge tax bill. We switched CPAs to one on our list. We were using a bigger firm that just, I don't know, it got lost in the mix, or we got lost. But we were kind of getting our financial advice from the CPA. Mm-hmm. And sometimes that's okay, at least the tax advice, right? So now this year we're able to take those huge deductions for the short-term rental. And my goodness, they're huge. They're massive. Yes.
Yeah. I would say the way to think about it, and it's funny in the industry, CFPs and CPAs will kind of butt heads sometimes. And it's actually a good thing. The CFP should be kind of like the quarterback of your team. If you think of if you're going to hire like an interim CFO of your life, of your financial life, the CFP is that. And they know enough about each area of insurance planning, tax planning, estate planning, investments planning, of all these areas. That's what the courses cover for a CFP. And if they're real estate specialized, all that related to those different areas, they will know who to refer you to when you need like some more in-depth tax advice. So like in my case, if I was working with a real estate investor, and we'll just like use your example, if you came to me and showed me your tax returns, I'd be like, okay, so this one's a short-term rental, right? Now it doesn't look like they did something here, just go back and talk to your CPA about it. That's kind of what the CFP would do in a situation like that. If they see it's missed, so try not to step on their toes too much, but you want to just make sure that a professional's doing what they should for you. But then if something is missed, we got to get a professional in there that's going to do it. It's like, you guys already did that, but that's where a CFP, your life isn't compartments, it's all together. So a CFP would look at your tax planning, and they would look at, okay, how many kids do you have? What do you enrich want to happen when you guys pass away? How do you want it to happen? Okay, you've got an attorney you're working with. Okay, that's great. What do we have set up with that attorney? Okay, this little thing here, maybe this is something I don't understand, but I'm kind of unsure about why the attorney did this. Can you ask him for me and get back to me? So some of these pieces, usually a lot of times like a CPA, an attorney, or an insurance provider, like your State Farm agent or whoever, your insurance broker, will be working in their silos, but they won't see the whole picture of what your ultimate goals are. And, getting this certain deduction on taxes might not line up with what your estate planning goals are. And not everyone needs a financial planner, a certified financial planner, but man, it can save you and your heirs. Really? Yeah,
Like this
it
is
can
the
save
first
your
time.
heirs. It can save your heirs millions
Yes.
if you have a good financial planner that's catching things. And yeah,
Yeah, yeah, your estate planning for sure. No, like I said, I'm yeah, I'm sold. I just I need to find one. And so typically fee based is what you recommend, or and then what can you expect to pay in fees?
yeah. So the industry has had this, without going into too much detail, our industry is trying to go through a reform of how fees are transparent and change. And there's so much lobbying from all these different groups that it's just a really
Mm,
hard push. But thankfully,
yeah.
there is a movement of advisors and planners that are what are called fee only. So fee based. So this is, I'm already going to muddy the waters for you. Fee based means that they can also charge like a percentage of assets that they manage, which is, there's nothing wrong with that. It's a way of getting paid. And that's the way the industry has done it for like thousands of years. There's like
Mhm.
Egyptian tablets of people charging at 1% for some wealthy individual. So it's a very tried and true way of managing assets for people. But a financial planner is not an investment manager only. They're, like we've been talking about, over everything. So this movement of a fee only planner where you pay him or her for their either an hourly rate, or a lot of them will do like a retainer rate, so that they're just kind of like an attorney that you have on, like at some level, you might just need an attorney on call all the time and just not have to worry about getting billed all the time. So a lot of times
Yeah.
financial planners will have this model where, like I said earlier, maybe 5,000 a year, depending on the complexity of your situation, to just, that includes maybe a once or twice a year, like sit down meeting, but you have access to them. They know your situation inside and out. So if you're like, I sold this property in Florida, should I do this, or should I gift it? We're getting to the end of the year. Is there anything I should do? Should I talk to my tax preparer? You have them on call. Usually the good ones start limiting their clients, and they will only go by retainer to be available to the people that they like working with and that are that they can really help. So, but there are some that do hourly too, and it varies. Think about what it takes for a plumber to come and fix something at your house. Yeah,
Right. Right. Well, if you've got
350
somebody
bucks, yeah, or more, like at least.
exactly. And
And
if
that
someone's going to show
doesn't,
you how to save hundreds of thousands of dollars, then yeah, it's
yes,
worth it.
yes. And the plumber's fixing that so you don't have a $20,000 floor repair.
Right. Yep.
It's the same kind of idea that if you don't know what you're missing if you're not paying a professional to kind of walk through it and try to find something.
Yeah, it's too complicated to figure out on your own. There's too many things, but um, right now, I'm sure people don't have a lot of choices at this point of the year, but we're mid-December, almost the end of 2024. What could people implement right now to try to get last minute tax savings?
Oh man. Well, if you call your tax preparer and try to do things, they're going to hate you because that's why
Yeah.
everyone procrastinating.
Yep.
There's a lot of the things that you can do. You have up until tax filing to do them. There's a couple different lists of things that you need to do before year end, things that you can do after year end. Some things are kind of unique where, like, if you have, like, I think it's a solo 401k, you have to set it up before the year has ended, but you have until you
Okay.
file your taxes for that entity, depending on what entity you have the solo 401k with, to fund it, but it has to be set up before the end of 2024. A solo 401k is an awesome vehicle for someone who is, they're the only person working in a business. You can fund it really highly, and it's very flexible. I used one when I had my firm, and it was just me. It's just a
Mm.
great thing to use. But I would say, at this point in the year, I am usually telling people that, the ship has kind of already sailed, but what I would do
Yeah.
is I would plan for next year. What do you
Mhm.
want to make sure that you hit the ground running next year? Because that's you're going to have a bigger impact that way.
Yeah.
And as far as tax savings, you need to start planning. If that's a big hurdle for you and you're really interested in like tax savings, you need to plan that all year long. Like next year,
Yeah.
we just bought a short-term rental, another one. And we intentionally bought it in the fourth quarter so that we can put a whole bunch of hours into it. And we can get a bunch of deductions before the end of the year, with some bonus depreciation. But you got to know what you're doing. Like there's a lot of things like the IRS will come back, you have to keep logs of all the time that you put in for some of these things. So the tax planning stuff doesn't really work real well in the last couple weeks of the year. You might be able to like buy some expenses that you're going to buy in January anyways, that if your income is higher this year would help you. But other than that, and there's, you can do, I don't know how long, we don't want to go down this rabbit hole too far. You can buy vehicles and things like that. But again, don't buy something letting the tax tail wag the dog. You got to have a pretty good plan in place.
We did do that once. We bought a property on December 30th.
Oh, that's
not a
awesome.
property. I'm sorry, a car. We bought a car and got a pretty good savings. But that's something you would obviously run by your CPA. I like to do my tax planning either super early in the year or after April, when CPAs have more time because they're just really, really busy before April.
Yes, that's very smart. Yeah.
Or get that CFP to help you. Yeah, love that.
Yes.
All right. Well, we only have a few more minutes left. There's so much to talk about. IRAs, 401ks. We are just going to have you back to go into more detail on some of these financial planning tools. But kind of like we talked about earlier, it sounds like you're a big real estate guy. For you personally, how much do you like to see in your portfolio allocated to real estate versus your 401k or your IRAs? Or do you have real estate in those?
Yeah, you're going to put me on the spot.
I am.
I'm very heavy real estate. I would say I'm very heavy real estate.
Feel better.
Yes. I'm well over half of net worth in real estate for sure. And the reason we talked about before, the things that I've seen that do well in the long run are real estate and businesses. And that's been true for, I think, probably since the dawn of time. And that's just, I'd rather play a game I'm most likely to win at, and rather than one that I'm not. So yeah, I lean much more heavily to real estate, but with that, I use other investments and cash as reserves. I think the more real estate you have, the more loans you have, the more leverage you have, the more responsibility you have to really be calculating, what happens if my short-term rental doesn't rent out for 4 months, or what happens if a tenant squats in a property and I have to pay a mortgage for 8 months and I've got 3 other properties. Do you have the reserves to make it through one or a couple of those? And, really be looking at that, because staying in the real estate game is the way to win at it. And if you can't stay in it, it will really hurt. And, you can come back, but it's not an easy road. So, and the reserves and savings for those unexpected things are very important. Try not to get out over your skis if that's kind of the route you're going.
I love that.
So, yeah.
It makes a lot of sense that, the liquidity that you want to have on hand and invested is perhaps the liquidity you need as reserves for your properties.
Yeah. And you said something about Roth IRAs and IRAs, that can act as reserves too. You can use those for some of the tax benefits and diversity for your portfolio, and it still can be reserves. I'm a big fan of separating the Roth IRAs, 401ks, that type of tax code from the real estate tax code, and not commingling them. You can, and it's totally fine. It's a great way to get into real estate investing if that's the only way you can go about it. But the tax code was written with certain benefits for each of those, and some of those get taken away when you put real estate inside of a retirement account, or there's some extra taxes that you need to watch out for if you put real estate inside of a retirement account. Again, I had clients that did this, and a lot of people do it, and it's totally fine. It's a great way if it's the only way you can get into real estate, but preferentially, I'd love to have them separate, because then you're also still diversifying. Even if you're heavy real estate, you've still got some of this other stuff that's just totally liquid, a little bit of a different tax thing. There's some great estate planning things with Roth IRAs, some of that other stuff. So if you can have a little bit of both, that's my preference for sure.
Love it. All right, Kyle. Well, it is always so fun to have you here. We just have to have you back soon, if that's okay.
Would love it. Yeah, anytime. Always like seeing you, Kathy.
All right. And maybe we'll get to see you and our audience at our upcoming event. We have our Real Wealth Passive Wealth Expo, where we're going to take some time to help people plan for 2025 for their real estate plan and their overall investment plan. There's going to be a lot of great resources there. You can get those details at realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.